Good morning, everyone. Welcome to Thursday. I'm having another one of those weeks where I don't know if it's going quickly or going slowly. Morning, Kate.
Good morning, Ryan. How are you, man?
Yeah, good, mate. You?
Yeah, I'm going to be glad the month, and not only the month, but this week will be over. It looks like we had 2 months in one in June.
Yeah, it's been one of those ones, isn't it? A lot of stuff going on the fixes and everything, and moves around the hourly marks and everything. It looks a bit more settled this morning on that front, but we'd have to see whether some last-minute deals are put through later today. The dollar's still got a fair bid about it, but as I say, it doesn't look as volatile as what we were seeing at some point yesterday.
That's true.
But we shall come to the prices. Sorry, mate.
Yeah, what I noticed is that perhaps currencies that have mostly Asian-based, let's put it that way, seem to have quieted down a bit, and it's the European currencies now jumping around, like euro, sterling, perhaps a bit of Swiss to do there. Also noted that EM is a bit on the march. So I reckon we still have some end of month, quarter, half year flows to be dealing with, but we will see as the day unfolds.
Yeah, I did wonder if we might get something in Japan being a Kotobi fix as well today, or Kotobi date.
We had this last run up to 136.80 again, roughly, and that was it. And then these global yields coming off kicked in, despite numbers in Japan and news out of Japan not being great. As I was saying yesterday in the room, it appeared to me that dollar yen at least or yen crosses were a bit out of sync with what was happening in the interest rate or in the yield sphere, and indeed it reacted once the Japanese fixing was kind of over.
Yeah. Well, before we look at all the bits and pieces, just want to point you out to the ForexAnalytix platform. I'll pop the link in the chat room for you there. You can see that on your screen. If you want to come and join us in the platform, you're more than welcome to do so. If you go via the link on my Forex Flow page there, you can grab yourself a 20% discount using that code. That gives you 20% off for the lifetime of your subscription. So please do check that out there. So let's go on to the bits and pieces, as we like to do. Bit of news out of Japan, just on the automakers. The production there fell year on year for the third month running. So supply chain still biting over that. What automakers have been doing is putting more and more workers on furlough in the auto industry. So that situation in particular isn't looking too good. Obviously, car making is a big export in Japan, big global business for Japan. They've got plants all around the globe, US, everywhere. So even just in the Japan side of things, it's going to be reflective around their global entities. So that plays into the sort of profits and things like that. But also when we get these repatriation flows around fiscal year ends and things like that, this is all going to play a part in that in the future. So not looking too good in Japan at the moment. Looking at some of the other numbers, industrial production down 7.2%, probably largely reflected of what's happening in sectors like the automakers. So not looking too good in that itself. What we did get from China, though, and it should be pointed out, this is the National Bureau of Statistics PMI. So this is the actual Chinese derived data, not like a third party market, S&P Global, that sort of thing. Pretty strong bounces we saw there. Manufacturing got back into expansion. That's the word I'm looking for. Services, big jump there, back into expansion, 54.7 from 47.8 prior. That's largely due to obviously the opening up of places like Shanghai and coming out of these lockdowns. There's still some negativity within the underlying numbers that I saw people pointing out on FinTwit and the like. So it's not wholly looking rosy at the moment, but on the headline numbers, a decent jump there. So one thing to look out for. I'm not sure when we get the third-party numbers, but we'll keep an eye on those, see if they match them, and then we might get a better idea of what's going on over there. We did get Russia, Putin responding to all the NATO stuff with Finland and Sweden, pretty much as you might expect. He said he will respond in kind if NATO deploy infrastructure in Finland and Sweden, and he doesn't rule out that tensions will rise between Russia and those countries because of their move there. So a bit of hot air, nothing overly strong. The market takes one look and thinks, yeah, that's what we're expecting, and moves on. Obviously, as we were talking about yesterday, got to keep this situation in the back of your mind, because one bad headline and risk takes a dip and stuff like that. So moving into some of the data we got this morning, last numbers from UK GDP, there or thereabouts, showing pretty much the same as what it did in the flash numbers. Quarter-on-quarter growth for Q1, 0.8%, 8.7% on the year. Obviously, that looks a strong number, but back in 2021, we were locked down this period, Q1, so no surprise that the year-on-year looks so strong. That'll probably wash out in the Q2 numbers. And we'll also see what Q2 looks like and whether growth has gone in complete reverse on a quarterly basis, and we start stoking the fears of recession. Over to Germany, import prices a little bit off, still up, but not a huge change there. Still floating at big levels. Obviously, things like energy is a big part of that as well. Retail sales also a little decent bounce there, a bit higher than expected. Again, with the year-on-year number, is there some potential skew in that because of what was happening last year with lockdowns and stuff? So I'm not overly concerned about seeing that number there, but on the month, still German shoppers are shopping, and that's what the ECB and the government want to see. Now we've got some more CPI data, and no surprises to see that CPI is still going up. France posted 5.8% versus 5.2% prior for their CPI number. For the Eurozone, HICP metric, 6.5% as expected, still up from the 5.8% seen last month. German unemployment, now this was a bit of a funny one, came in much higher than expected. The unemployment rate jumped, the unemployment change was higher, unemployment total was higher, but some people are pointing to the fact that there's been a lot of Ukrainian refugees coming into Germany, looking for work, registering with the official employment office or unemployment office, whatever they call it, and that's potentially been the big boost here. So not sure if it looks as bad as what the numbers look like due to that factor. So it could be a case that the market will look through that, and if the ECB are looking at unemployment all around the Eurozone, whether that sort of factor is going to play in to other countries. Hasn't seemed to have played into Italy. Their unemployment rate dropped much better than expected, down from 2 pips from last month. So that's pretty much what the data we got this morning. Obviously, the big data coming up today is US PCE. Where are we? There we go. Now, from the CPI numbers we got from the US June 10th, that showed a decent jump in CPI to 8.6% from 8.3%. But the core dipped from 6.2% to 6%. And we're looking for pretty much a similar theme here in the US PCE. Let's get up there. Now, there's no expectation, I can't see on this chart, but for PCE or one of the other calendars, it's expected in at 6.4% versus 6.3% prior. The core is expected to drop a point to 4.8% from 4.9%. So again, we've got that little bit of the difference, the divergence between the headline number and the core number. Now, as we know, we had Powell out yesterday talking about inflation, and pretty much the context from him is that you know, they are going hammer and tong to fight inflation. So it may not entirely matter whether there's this divergence between the core and the headline number. If the headline number comes in strong, then you know that's going to keep the Fed expectation going that they're going to stay on their path, 75 pip hikes at the next meeting and potentially following thereafter. But one of the key comments that I picked up from Powell, and I was a bit numb to all the central bank speakers yesterday. One of the things he said is that because of high inflation that they've seen now, they now understand better how little they understood about inflation. Now, this is coming from a man who is at one of the biggest central banks in the world, telling us that they know little about inflation and how it works, which sort of tells me that, you know, it's a bit bonkers. How can you be in that position of your whole mandate, one of your whole mandates is price stability, and you don't understand inflation, and they're admitting they don't understand inflation. I mean, to us, it's been obvious for the last year they haven't understood inflation because they've been behind the curve all the way through. But it's just coming out and saying that in public. I'm surprised it didn't get a bigger reaction in the presses, because it really is, you know, a big thing to say that they don't understand inflation when they're setting monetary policy for the whole country around the globe to combat inflation. So really, what do they really know? So many other comments. We had Bailey sitting on the panel with Lagarde and Powell. He was talking a bit big again, you know, oh, they're ready to act if need be, and if they need to be stronger, they will be, blah, 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 blah. But he didn't really say anything that made you think, okay, that's a change in tone for policy, or, you know, we're going to get a 50 next hike or more, or whatever. So nothing much for him. He's still trucking along with his head in the sand. I could say it's stuck somewhere else, but I won't be rude right now. And we had Lagarde, who one of her comments was pretty much underscoring the importance of the CPI this week, and obviously we get the main Eurozone number tomorrow, so that puts a bit more focus on that. As I mentioned yesterday, you know, I think the argument over is it going to be 25 or is it going to be 50 isn't a huge deal for the market. It's more what the path is thereafter. As we've heard from other central bankers, you know, we are probably leaning more towards the 50 mark. The Eurozone CPI will probably seal the deal for that if it's higher than expected, or at least confirms expectations. So what that'll do is that'll probably kick the 50 pip in onto the table in terms of the market size. But from there, it's how the market is going to judge what the ECB do from there. You know, if they were supposed to be going 25 this month, 50 pips in September, does that make it now 50-50? Do they go 50-75, something like that? So it's not so much now whether it's 50 or 25 at the meeting. It's more what happens after. What's the message from the ECB after? But of course, as we'll get into that July meeting, 21st of July, we'll have the short-term price moves, because if the market is expecting 50, then the big price risk becomes if they only go 25. And likewise, if the market is only expecting 25 and they go 50, then that's where the price risk. So it's all about matching what will happen on the day with what the market would expect up to that day. And again, we'll watch the data, because the data will push those minor changes to expectations around the 25-50 pip argument, as we've been seeing. Kay, did you take anything else from the waffling from the central banks?
Yeah, I think it's like sorry, I think it's like the second time, and now I was trying to recall it and I forgot about it. But well, that Lagarde is kind of leaving the door open to a possible 50 BP in July, where the forward guidance, if forward has any meaning these days, is clearly for a 25-50. So I think if CPI tomorrow comes out higher, the market risks repricing the July meeting, the nearest one, and I think it's going to be pretty important. It could get very volatile on the number tomorrow, especially that we're coming out of end of month, end of quarter, end of half year, with clearly some euro selling, dollar buying. It could, if this number comes out high, it could really see a spike in a short term, probably spike in the euro dollar, but nevertheless a spike in the euro. And we have to combine it, of course, with today's US PCE data. But I found that over the last two of her interventions, there was this kind of leaving the door open to possibly doing 50. And we'll see, as you say, from there, we will see how the path will be looking. And as we have seen many times over the past weeks or even months, the money markets and the bond markets are so volatile. The pendulum swings from one end to another violently. Even bond traders are saying that they've never seen swings like this in the past, going from up and down, pricing in out 50 BPs at a time. It's violent out there. So I think, being the first of the month, being a Friday, we have to be very careful with that CPI number coming out tomorrow. In other news, we had to just finish on Japan. We had the Bank of Japan coming out saying that Kuroda is still on the autopilot, and they keep their amounts and frequency unchanged for the July-September period for their JGB purchases. I really don't know what they're up to, but it's. Okay, they might of course surprise. When is the next BOJ meeting? It's going to be in the 21st of July. Things may change because we will have the members, the BOJ government members outlook as well. So things may change from one day to another. But for the time being, it's still on autopilot, which makes it a bit tough to stay long yen for longer, right? We had this move down that both you, me, and quite a few people in our room picked yesterday, which was great. For different reasons, there was this technical zone 137.2040, which I hinted at, which should have been a bit of a resistance. There was the overshoot on the previous high, as you already mentioned. And then when I was looking at the yields, I really, and I said it in the room as it happened, and we went short the yen, and with some decent success yesterday and overnight. Something was out of sync with the yields. Global yields were coming down, and I showed a couple of pictures as well this morning. And when we had the acceleration down to 136 in dollar yen and the yen crosses, there was a clear out of sync move in yen and versus what global yields were doing. I think a lot had to do with the end of month quarter, end of quarter in Japan, of course, as well. Although the end of half year in Japan is a bigger one to watch. Write it down in your diaries, because the end of September is a much bigger one. And we saw then this move develop despite lower data, as you were already mentioning, the economic data, the automakers, it's not looking good in Japan. Yet we corrected some of this out of sync move with the yields. And then lastly, this morning we had the Riksbank, Sweden's Riksbank, raising, as expected, 50 BPs to 0.75%, leaving the door open for more on their presser. They were even hinting at a possible 75, but I think it's in line with all central banks right here and now. They are leaving the door open to whatever's needed. And we saw then the move on the Swedish kroner strengthened by about 1/3% as the news came out on the fact. And then now Swedish kroner is actually trading a little bit weaker. I think the market, and it might still be these end of month shenanigans and stuff, and we will see what happens tomorrow. But there seems to be a little shift, in my opinion, in the market, slowly starting to operate. But I might be wrong. But we will see that tomorrow and next week. That inflation data is not necessarily, and raising rates on the base of inflation data is not necessarily bullish the currency. And we've seen a bit of that in sterling. We've seen a bit of that in euro, which failed. Well, ECB is behind, but we've seen a bit of that in other currencies where they raised rates, like the commodity currencies, Kiwi, Aussie, and stuff, where the currency is not necessarily rising on higher inflation. For the ECB, it might be a little different, but anyway, for the Stocky this morning, despite being on a hiking rate path, they expect to be around 2% going into next year. But despite that, the Stocky hasn't really moved. And I think for what's happened, that's about it.
Yeah, yeah, I think you're right. And, you know, just looking at the ECB, you know, there was a headline out, one of the wires, that traders now see less than 150 pips of hikes for the ECB by year end. Now we've got 5 meetings left in the year. So if they've seen less than 150 pips of hikes, that's less than 0.3 a meeting.
Yeah.
So if we're going to go 25 or 50 in July, how they get to less than 150, you know, it's like a couple more hikes and then they're done. So it's going to be, we get to this sort of period where we've got to watch what the market is telling us and the clock in how many meetings we've actually got left for them to do their expected hikes in. So if we're going to get to 2% by the end of the year, you know, that potentially means they go bigger increment now and then they slow it down into the end of the year. You know, obviously based on what the data says. But it's these sort of minute changes or snaps in thinking that is going to cause us these price moves. You know,
the thing is, we need to note as well, and we can't stress it enough, that end of quarter, end of half year flows, because I've read as well that there's some rebalance to do in everything, FX, equities, bonds. It's rebalancing a go, and I want to see really if it's really repricing. Because the market always, and the journalists and the market always like uses repricing, but sometimes people have to just rebalance portfolios, which has nothing to do with repricing. They just have to do it if they're overweight compared to their models in bonds, or underweight. Well, they will have to sell or buy, and sometimes I find this use of repricing, it's a real yo-yo, and the pendulum swings from one day to another. I mean, perhaps tomorrow or next week, rather, perhaps, we are going to see yields pop up again. And what are they going to say? They are repricing hikes. I mean, sometimes we have to be very careful when we talk repricing. I don't even like to use the word when you just see like 1 or 2 days of yo-yo on end of months, but that's just in between.
Yeah, I mean, it's the point we've been making pretty much all week. You know, what you look for in the end of month stuff, because you can get confused by it, can, you know, make things unclear what's going on. Is you look at the wider picture and you say, right, well, is the price moving out from away from what it was in the fundamental picture before? We know where the Fed is going. We know what they're going to do. Nothing really has come out that's changing their mind. There's been no data that significantly said, right, oh, the Fed are going to have to go hike more, or they're going to have to hike less. So if you get these moves that are out of kilter with what the market thinking is before we came into this week, then that's when you start to think, well, that's potentially one thing. That's where I'm going to look to trade. And that was pretty much my basis for my short yesterday. Yeah, we broke above this 70s high, and I like trading a big figure anyway, and looking at the clock, the time it happened, you know, 30-40 minutes before the 4 o'clock fix. So I was like, right, fine, I'm gonna have a short against the big figure, see what happens. And it played out, this one. I'm still short a little bit. offloaded at slices all the way down. Lowest slice was 136.05. But meanwhile, it hasn't really got anywhere. It could have, you know, if it had shot up to 138, 139, I was already itching to be short. I would have probably tried it up there as well. So it's all about picking the areas. But what I want to point out here, because I think it's pretty significant for the price action. We obviously had that prior 136.70s highs. We found resistance just below it yesterday. Then we got the pop above. But what's significant is that we've got this price action where it came back below and then the level found itself again. Now that to me shows potentially signs of getting a top. And as I've explained previously, when I'm looking to pick those tops and pick the bottoms, I want the price action to confirm that for me. I want it to show me that this level is something I can potentially rely on. And so we've got that. Now, what happens here is how steep are the pullbacks? How deep do we come back? If they're pretty shallow, down to 136, then that tells me that we're perhaps not done. You know, we've had the crack of the egg. If we don't pull back significantly, we're going to get another move up. The same sort of situation happened back here when we were, let's come out a bit further, down here around the 131s. You know, we got that move up. We had another phase up, hit the top, did a bit of sideways, bit of dipping, came back up, held it. You know, we got some decent price action. The price action confirmed the top, and for the moment, for that period, you know, we weren't going higher. Got a decent pullback. Then we got the explosion up through, and here again, you know, you zoom in a bit, we found that bit of resistance into that area again, where all those sellers, you know, parking the bus, bang, stops above, and off we go again. And then we're back to what happens now and what develops now. So I'm not saying what happened back here end of May is going to be exactly what happens now, but for me trading it, I'm looking at the price action. The price action is telling me this is a line, and it's becoming more of a significant line than it was when it was just a one touch. And now we need to manage it up. Where do I think the crack point is for this phase? I still think it's around this 134, 40, 50 level, even though we had that pretty easy break before. So maybe we might need to set the sights a bit lower to 25, 30. But after we had those two moves, look where it held again. So now I've got a bit of a range to play with. You know, 136.70 down to this 134.5. And that is all I do when I trade. I look to see where the ranges are. Where can I have conviction to lean against, depending on the news? So for me, you know, I'm in a bit of a short off the top, happy to sit in it, see where it goes. I'll trade my stop behind it. If I get stopped, then I'll go back to sitting on my hands and seeing what the price wants to do, where it wants to find the levels. My next main level around here is down at 135.60. Again, another break point. Broke up, then we had a little bit of wishy-washy. Then again, it's shown up as a level. That's what gives you the idea to say, right, this is something I can rely on. This is something I can manage my risk again. So it doesn't matter where I think that it's going to go higher or going to go lower. Although I'm still got a short bias overall, because I think we've come a long way very fast. And I think if you're looking at the fundamentals, particularly on the US side, things aren't you know, turning real south yet. The Fed no real position to make a big change to their policy. So on that side of things, you know, I'm not sure how much further we can price in the Fed trade. But then on the flip side, we've got, as we explained today, what's been happening in Japan. You know, things aren't looking as good. There's still pressure on the Bank of Japan to change tack. And so while they don't do that, then there's still potential for more upside. And that little pop above, be it month end, whatever the reason was, just shows you that buyers are still ready to get in there if they're given an inclination to do so. If they're given half an inch, you know, they'll grab it with both hands. So I don't rule out that we're destined for 139, 140, whatever. But just let the price action do what it wants to do, and that's all you can rely on. You know, looking at the euro, you know, again, we traded the ranges. I shorted up here 106.09 the other day, off into the low 105s. Now I'm waiting. 105s has broken. That's going to become a little bit of a pivot point probably. Are we going to get a test of 104? If we get a test down here, I'm potentially going to be looking at that for a long. And if it's coming in this end of month period, then, you know, the dollar's been well bid as we've seen the last few days. You know, if we get a last shove down there, we're only 20, 30 pips off it at the moment. I'm potentially going to be looking at a long. And the reason is, what's changed for the ECB? They're going to be hiking. The market isn't going to move 200 pips on whether it's a 25 or a 50 pip hike. You know, that's just not going to happen. But as Kay says, we could get some decent moves tomorrow on the CPI numbers. That'll be the first day of the month. And that's also something I like to flag up. Just as we can see stuff at the end of the month, and particularly on quarter ends and something like a half year end, we can also see fix action in the first day of the month. And the reason for that is that some investment firms at half year end, they can book some profits, close out some trades because they produce reports, so they can say, you know, in the first half of the year we made X, Y, Z, pay dividends, give out money to investors, whatever. So it can be a simple case of they close down some trades, take profit of some trades into the end of the month, and then reopen on the new month, or they reallocate their balances. So where they may rebow this month, they may enter new allocations in the new month and new second half of the year. So, you know, don't think that today's end of month stuff is going to be the end of it, because I've seen time and time again that on the first of the month you can get some additional moves, maybe not as big, but they can catch people on the hop if they're not expected. But in terms of trading,
on this side, if I may, yeah, you're absolutely right, and it could be especially because on Monday is a US holiday, so they might either do two things: one, to press those new, or at least part of new investments or rebalancing through tomorrow, which could lead to pretty sizable fixings again, or wait for next Tuesday. But they have a holiday on the US has a holiday on Monday, so there might be some decent stuff to do tomorrow. In fact. Yeah,
exactly. And yeah, good point on the holiday. So, a nice quiet Monday. We'll have a little laugh on Monday then. Set off some fireworks on behalf of the Yanks. But anyway. So looking at some of the other prices, you know, again, it's looking at the levels. I know Kay's been in Kiwi. I've even got it on this chart. Yes, there we go. You know, looking at this 62 level, proving pretty solid. So here's a potential case where the techs are outweighing, or the level is outweighing what people need to do at month end. Again, it's why you look at these levels, because if the market is going to really make a move, this is the sort of area it's got to break. You still long in this one?
Yeah. I just bought it last night, so I've been jobbing just a little this morning on small pips. So I'm long at about. I'm long about 62.15 right now, and I'm just respecting the 62. I'm going to try and defend it, even if we get a small break over. If it's fixing related, a break sub 62, I'm going to try to hold it. But if post fixings we really break, then I think it's no use to keep it. This is really a big level that has been traded and holding for actually a quite a decent time on the Kiwi. So it is really a good level. It already had it's a level that's been holding and then traversed violently in 2020 on the when the pandemic broke out, but it's basically been holding since 2015. Apart from that, it's really a big level. It is a real big level on this Kiwi. Do you want me to grab the screen for a while to show people a couple of things that I'm looking at? Ah, we lost Ryan. Probably going for a drink.
No, I'm here. I'm here.
Okay.
Hang on, I'm just stopping.
Okay.
I was saying, yeah, you've got to love these long-term levels. You know, I love them
We have to
because they're
respect them,
big
right?
levels for a reason. Yeah.
We have to respect them. It's we can look at fundamentals, but fundamentalists or yeah, people who trade fundamentals, we look at levels. We are not just there thinking like, oh, fundamentally this is should happen or that should happen and let's go. No, we do look at levels, and this 62 is really a big enough level to just give it a try. You know, that's my opinion anyway, and it's. If it's been a decent month like it has been, it's worth looking at. Oh, thanks, Anne. Looking at those big levels is also what we do. 1994. Excuse me, Anne, but I don't think I don't see it in 90. Perhaps here and there. Okay, thank you. So this Kiwi level, this Kiwi is the one. Then let's quickly move over to what I showed this morning, and I'm just going to show some blank charts, nearly blank charts. One of the reasons I said yesterday this dollar yen seems really out of kilter, or the cross yen seems really out of sync with what's going on, was that since yesterday, all the yields, so these are the short-term dollar yields, these are the short-term German yields. Can you move over to the belly of the curve, the 5, 7, and 10 year on the dollar yields? You move over to the longer term. You move over to the longer term Germans, the 10 and the 30 years, and then you go over to this screen, which shows like the UK, Canadian, and Aussie and Kiwi, and then look at what happened. The yen pairs really came off because the rest of the yields were coming off, where Japanese yields are in a virtual standstill, and then what is typical as well this morning is that Aussie and Kiwi are holding up a little bit better. And I think the reason might be coming here. They came lower, but then have been holding the whole night, where the rest of the yields, the global yields, are coming off. So that, to me, that explains enough the move that we saw in the yen pairs. Then let's look at our traditional ones a little bit. The metals, yeah, gold is struggling to stay into this triangle or to keep this support line. As I've been saying, to me, the 1780 will be decisive here, yeah, that's around the 1780, 85 here. Will 8090 will be decisive for me in the more medium term. But in the meantime, it's struggling to hold into month end. I said, don't discount month end in there as well, because I said already many times today, there is rebalancing needs in every asset for half year and quarter year. And same thing on the silver. Didn't hold this 90, 20, 90, 21, the figure zone, tried it, but failed. And now we are looking rather to see if we can even hold 2045 into the end of the month, which will be interesting. Okay, let me straight take, who was it?
Kareem, Aussie yen.
Aussie yen, yeah. Let me go straight over to the Aussie yen. Okay, I mean the Aussie yen is a little unsure here. We're a bit of on a support. We can have another support here. Again, Kareem, the triangle is closing, which is going to make it very interesting for tomorrow. I think tomorrow, the opening of the month, this one is going to be a very interesting one to watch. Thank you for the question there, Kareem, and the look at it. So we are in a relatively, this is 60 points wide right now, or going into tomorrow, or up to a big figure wide. It's going to be an interesting interesting one on the Aussie yen to watch, and all will depend on how commodities will open tomorrow, in my opinion, and what's going to happen on with each of them, because either Aussie can move on the commodities, or the yen can start to or will probably still move on yields. But this one is indeed an interesting one.
Do you know? Do you know what I hate about triangle patterns is when it just goes sideways, as it has been right out the
comes out
triangle.
of it sideways, yeah.
Yeah, and you get out the other side, and you're like, oh well, what do I do now?
Yeah, what I then tend to do is look at the last one. This, for instance, this one is going to be around 93.40, 94.40, and 93.5, call it, with the support a little bit lower at 93.20. I think this, and then yeah, call it even another one at 93, the figure. So it's gonna play. It has to play out. I think 93, the figure, looks to be a pretty decent one as well. Looking at prior lows. But let me move on quickly to my traditionals, because I know people. Some people look at emerging markets as well, and the interesting one today. Look at this from 2020. We have zones of interest. We have retracement levels in the 1630, 35, 36 zone. And we are trading 1625.5. We tried it yesterday around 1628.29. We tried it this morning around 1628.29. I'm not going to trade this one into month and quarter end. It's and as I've been saying a lot of times, anything can happen. We can see such a strange move sometimes, on especially end of quarter, end of half year. I'm not going to trade it today, but I will keep a very, very close eye on this one come the reopening tomorrow. I must say that barring one or two exceptions, the rand data have not really been that bad. So I'm keeping an eye on them. And also keeping in mind it's a real high yielder still as well. The other big high yielder mix, yeah, we're turning around this 20, 21, 22 again. I also think it has to do with the end of month. We have seen some spikes in dollar mix, which usually later in the session in the US get undone. But later in the US session, like US afternoons and stuff like that. It's a little bit of a zone here. I allow for the end of month to get past the end of month, and then we'll see this one. But if we start to get back below 2010, I would say after the end of month is done, we might get a chance to get back to these lows. The one that I'm, as people by now know, the one that I'm most interested in is Euromex, because the diversion is the biggest in the central bank divergence in yields is the biggest one over there. You are looking at a negative yield in euro still, and 7.5% in Mexico. So this one here, I let I covered it yesterday. The last of my outstandings, I'm letting the end of month go by as well, because I don't know what's going to happen. But in the fresh month, if I don't see this trade above 21, 23, 27 to start with, and even above 21.40, I'm for sure going to try to get short again. It leaves me also the time to let those end of month flows go by. So this is one I'm going to again start to look at tomorrow.
Do you want to look at Kiwi CAD for Jack? I know he's playing this one in our room.
Yeah, I know. It's just that I've got no. I don't even have a Kiwi CAD.
Okay, you have to wait for the room for that one.
Yeah, look, my Kiwi CAD chart is empty. But
No.
The one thing, Jack, I understand those risk rewards in the low 80s because we have come a long way. But do you have any like fundamental reason why you would be long Kiwi cat. And okay, they have different. The New Zealand and Canada have different export patterns, and they export different stuff. But if you look at it from a commodity point of view, I find them really, of course, Canada has been helped a lot more thanks to oil moves. So there is some reason why this thing came off, but then somewhere in my view as a fundamental trader, I tend to trade Aussie Kiwi and CAD kind of the same direction. Okay, barring the divergences in what I just said, oil and commodities. So it's a cross that I don't honestly speaking don't even look at, because it doesn't really frame too well in what I'm looking to trade and the way I'm looking to trade stuff. But yeah, I can see what you mean on low 80s being a decent risk reward. But if I look at it on the daily, you're still trying to catch a knife, right? Yeah, low 80s, and then you 79.5, 79 the figure. I think if this goes below 79 the figure, watch out, because you could be in a bit of pain if trying those knives could pierce your hands if you don't wear Teflon gloves.
Yeah, I think that the break, this break we're seeing at the moment, you know, if it's looking like it's holding, you know, just below that line you've got there, then you know that's when you tend to think, you know, is this going to have further to go? But as long as you keep your risk manageable, you know, there's nothing wrong with
50% retracement of the really long-term move as well, right here at 80.40. Okay. Yeah. What else? What else?
Well, let's throw pound Swiss here. Yeah. While you
wanna grab that one, or shall I do it?
No, you can have that one while I'm enjoying driving while you're reading the map.
Yeah. Okay. I had the sterling CAD on here. God knows why. Sterling Swiss. Here we go. There, as you can see, Hugo, it's an empty one. No, I think the sterling, as you know, I've been short Euro Swiss for a while. I also closed it yesterday a bit early, but I think S&B just gave us like an absolute layup there to be long Swiss. In the sterling Swiss, where is it? Oh, I wasn't on the right one. All right, this one clearly broken down. Yeah, some decent levels around here. Okay, that's not what I wanted to do. Here, okay, we're in a bit of a and trying actually to break this zone. It could be false breaks below those lows. It's going to be a bit difficult to do those fibs, as no one really knows what the actual lows were in oh no, this 2020 I can do it. I thought I was looking at the 2015 move. So yeah, we are on the 78 point. No, that's a while away. Why is it also wide? Okay, 115.40. I would say watch out. This is the low we have seen around the lows we have seen yesterday. We need to, I think, close the day above 116.30 to have a chance to move up a little bit. But there's a lot of intermediate levels there that could resist. I'm going to be very honest with you. I'm not a huge fan of the sterling right now because I think BOE is not handling stuff decently, but then we could say that about all central banks. What I'm worried about in Swiss pairs is that the S&P really shifted, and they even said that in their opinion, Swiss franc was not very overvalued anymore compared to what they have been saying for years, when they were actively intervening that the Swiss franc on every occasion for somebody of the S&P to come on having an even one-liner, there was at least half a line there saying that Swiss is overvalued, and this time they dropped this line. So I'm a bit afraid if you want to trade, let's assume that you would like to trade it from the long side, there might be a better pair to trade sterling against than the Swiss franc. But that's only my very personal opinion, of course. I'm looking at it from the side of that. It was a bit of a shock what the S&P came up with over the past weeks, and I think it put a lot of people to think what may happen. So I'm going to let this end of month go by, and I might find a currency to trade Swiss long against again as the new month starts. And it's good to have those European CPIs come in tomorrow, because if they undershoot a little bit, I think Euro Swiss could really go. Perhaps why not see the 2015 lows again around 96? Who knows? So that's about my opinion. Anyone else?
Do you want me to grab it back?
Yeah, I'll give it back to you, mate. There you go.
Thank you. Yeah, so Hugo, it's up to you how you want to trade it. Completely up to you. Just because we don't have a huge view on something doesn't mean that you don't have to trade it. But you put in your own analysis. Find out your reasons why you want to buy it. Are you just buying it because it's just dropped a lot, or are you buying it because you've got some decent text down there that you want to put your risk against? And that's what you need to do. Judge why you want to buy it. Judge the risks and know which way you're trading against the central bank or with the central bank and the sentiment. And that's how you plan your risk. If you want to fight something like that, you go a bit lower risk and you keep your stops a bit tighter. Because if you're wrong, then you don't want to lose a lot of money on that. But anyway, you're not very convinced just to level. As I say, pick your levels and go for it, mate. So one pair I'm keeping a close eye on, Euro CAD. Here we've had a look at the upside. Here we are down towards this big area, and as we've been saying, we look at these big areas a lot. I've still got a sell stop in below that level at 133.80, but I am mindful, just thinking about it now, I am mindful that with the euro looking so weak elsewhere, is this end of month stuff. It may be a case that I may try along, and if we see down into that 134, I might pull out my sell stops because I don't want to get flipped out in any month end rubbish, or even just leave it all alone and see what happens after month end. If we've broken it and we get a confirmation, i.e. a retest of that level, and this happens after any shenanigans today, tomorrow, then perhaps I'll look at selling a confirmation there on a retest of that 134 area, potentially then looking for a decent break and further downside. But we're 56 pips off of it at the moment. Looking at the clock, see where this is come 4 o'clock today, see what's happening, make a judgment call there. And it's going to be pretty much the same for all the other pairs I'm going to trade or look to trade over this month end stuff. If I see some of these hitting decent areas, Kay mentioned Kiwi dollar on that 62 decent area. We're still hovering around these lows in Aussie dollar. If we find we get a move down here on the month end, but we're not breaking it, gives me a bit of conviction to think, right, well, let's try picking up some longs now. Let's try catching those knives, but I won't give them a lot of room necessarily. But it's all about the timing, as Kay said yesterday. It's not necessarily about the levels, it's about the timing, and that's going to be very important. I want to go back to a couple of comments. Arif asked, can traders sometimes overthink trades? Probably all the time, probably a lot of the time, traders overthink trades. We all do it. I know I certainly do it. And if you're in our chat room, been in our chat room a while, you'll know these month ends, we're always overthinking what goes on. I end up just virtually walking away from it, because we look at the models, what they expect, we look at the performance of stock markets, and you know, you look back on the conversation over the course of a week of what may happen at month end, and we sometimes just don't you think, we just tie ourselves in knots sometimes, overthinking what may happen. And that can happen in all aspects of trading. You overthink something, and that's why, and I won't stop repeating this, if you find you're going down the path of you overthinking something, stop, take a breath, look at your charts, and just trade the levels. Pick your levels. You don't need any thinking. When you've got a line on your screen that you've drawn that you think is a level, you don't need to overthink it. You trade it, you manage your risk against it, and you move on, and you make money or you don't make money. You don't have to overthink stuff. So if you're getting in that position where, oh yeah, you know, yeah, I've got 18 reasons to buy it and 15 reasons to sell it, you know, just take a step back, take a breath, clear your head, and just look at the levels, and then build up your reasons. I always have a mental checklist, if you like, of reasons to trade a level and reasons not to trade a level. And if I like all the reasons why I want to trade a level more than I don't want to trade a level, then chances are I'll trade it. But I'm a very cautious trader by nature. I probably talk myself out of more trades than I put on. But that's the method that suits me. I don't trade every level I look at, every level I put on a chart. But yeah, you know, yeah, you can. Everyone overcomplicates stuff. We all do it. You just got to know how to get yourself out of that. Kay, what do you think? Do you overcomplicate stuff?
Oh yeah. You should even technically, you should see my chart sometimes. Even I can't figure out why I put stuff on there sometimes. But no, of course it's human nature to overthink, especially if you are in trading, because you risk your own money. If you risk your own money, that is. So you tend to try to find reasons why you shouldn't be putting in a trade. But I'm like Ryan, and I remember, like, it's 5 years ago, Ryan, that we did our first webinar together, where I showed the people the traders cheat sheet, which I made, which is probably still valid. Well, perhaps I should adapt a couple of lines due to the pandemic or so, but it's still valid. And I have a cheat sheet which I made, and now of course I carry it around in my brain, but yeah, and once I'm in a trade, I check my list to see if the trade is still valid or if stuff has changed. And I must say that what Dale said the other day was absolutely gold. He said, when you're in a trade and it goes your way and you feel the urge to take profit, ask yourself if you would do the reverse trade at that level. And that's one to put on the checklist, which is gold. But yeah, I know we should not overthink, but we do it. It's human nature. But then if you have your own checklist, use it, and it will prevent you from overthinking. Yeah,
and Albert's just asked a question. Can you post the cheat sheet, please? Yes, we'll make it available for $199 special. 50% off for a week. I'm sure we can. I'm sure we can look at that for you, mate.
Please be welcome to join the ForexAnalytix crew, and I'll post it over there.
Yeah, that's cool. That's cool. And a quick question from Charles before I let you folks go. Will PCE move markets? Isn't inflation priced in? Yes, inflation's priced in. PCE will potentially move markets. And what I will say is look at the variation in what comes out versus what expected. As I mentioned earlier, we're expecting 6.4% for PC versus 6.3% prior. So we're only expecting a little pip upgrade on that. Given how volatile inflation is at the moment, if we get anything 1 or 2 pips around that, so maybe 6.2 to 6.6, the market probably won't do an awful lot. If we get a bigger variation than that, then you're potentially going to get a bigger move. But as far as the inflation picture goes, there's because everyone's expecting inflation, and as you say, the Fed priced in and based on inflation. The bigger moves are likely to happen if the data disappoints those expectations. So the way we're sitting at the moment, the market knows there's inflation here. They knew it from the CPI print. So if the PC comes in softer and significantly softer, you're probably going to see a bigger reaction than if the PC comes in well above. Just because everyone goes, oh shit, maybe we have got peak inflation. Quick reprice what we were thinking 5 minutes ago. And that's what happens in markets, and that's why we've been saying for a while data matters now, because it's bringing better price moves. So you've got to know where the risk lies with the data. So that's that for this show. As always, thank you very much for your attendance. Hope we give you some good value here. Please trade safely, watch that data. Please check us out in the chat room if you want to come and talk to us. We're here, we're in there all day long. What we talk about here on the show, we're bantering on about that all day long in the chat room. So if you're feeling a bit lonely, come and give it a go. We don't lock anyone into contracts. We don't suck you in and not let you out. If it's not for you, then you go with our best wishes. But anyway, have a great day today, traders. We will see you tomorrow. And thank you very much.
Have a good day.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.